Bank of Canada's Macklem says we do need to diversify our trade.
Swiss Economy Minister Guy Parmelin says Switzerland has made no concessions to reduce tariff retroactively. Bank of Canada's Rogers says the bank sees better balance in the housing market. Bank of Canada's Rogers says we don't expect another surge in house prices. And the news conference by Bank of Canada's Macklem has ended. Bank of Canada Rogers says I expect continued correction in higher priced markets. Swiss Economy Minister Parmelin says pharmaceutical tariffs for the moment stay at zero and any future cap is 15%. North American and European FinTech 2026 outlook remains neutral. So just to reiterate, according to Fitch Ratings, North American and European FinTech 2026 outlook remains neutral. We have posted the article from Fitch Ratings on the feed for those interested. According to Fitch Ratings, global autos outlook deteriorating on weak macro and trade risks. We have posted the article from Fitch Ratings on the feed for those interested. According to Fitch Ratings, trade tensions and potential for more supply disruptions also contribute to deteriorating outlook for global automotive sector. According to a Swiss official, saying we will talk to the US about medicinal products, robotics, and other items to prevent tariffs.
Aggressive absorption detected in S&P futures by buyers.
General Motors shares hit record high, last up 2.2%.
Wall Street Journal reports that Jeff Bezos' Blue Origin has had a team working for more than a year now on the technology needed for an orbital AI data center. We have posted the Wall Street Journal article on the feed for those interested.
Aggressive absorption detected in S&P futures by buyers.
Ukraine say that drones hit the Russian Shadow Fleet tanker in the Black Sea. So the previously mentioned Shadow Fleet tanker attacked by Ukrainian Navy drones is disabled as a result of the attack, according to SBU sources. Netflix shares down 2% now.
Good afternoon, folks. Hope everyone's having a good FedNest day so far. The big event awaits us just a little less than an hour and a half away till we probably get a 25 bip cut. We may get an announcement about an expansion of bill purchasing to start next year, up to 45 billion in T-bills to help to ease some of the liquidity constraints we've seen in reverse repo and bank reserves. And that may be the last cut of Powell's term. Fed funds futures are looking for the next cut to happen after his term expires in the June meeting, with a total of 75 bips of cuts from this meeting all the way through the end of next year. Obviously, the summary of economic projections we get today will be important for shaping those expectations, as will Powell's press conference. So mostly right now, markets are just sort of consolidating, preparing for this event volatility catalyst. We know the S&P has been trapped in a big range, about a 5% range, for a while as we approach this Fed meeting. I think this may be what helps to resolve that breaking above or below that range. And we'll have to see whether the market is happier about the near-term cut and the potential for bill purchases, or more disconcerted by the notion that moving out, we may not see rate cuts until Powell is replaced, ostensibly. So we'll be covering the event live right here, the press conference, the rate decision, the SEP, and the price reaction. Stay tuned.
ECB's McClough says that I'm confident medium-term inflation will be at 2%. ECB's McClough speaking in Dublin. So ahead of the interest rate decision for the Federal Reserve, where we get the expected forecast is for a 25 base point cut to 3.75% from 4%. We also get interesting here, the EU and UK reach 1.2 billion euro deal on 2026 fishing rights for EU fishers. Let's go back to, I said, we get the rate decision and we get the summary of economic projections alongside the rate statement as well. So looking at some research then, it's on the feed, well, it's just on the right-hand side of the feed. If you just click on unit interest rate prep, commentary from ANZ, they say the FMC is expected to deliver 25 base point rate cut, lowering the Fed funds target range to 3.5% to 3.75% at this week's meeting, a move that markets have already fully priced in. The decision is not expected to be unanimous. At least 2 dissents are anticipated, one from an official favoring 50 basis point cut and another preferring no change. Policymakers are also expected to emphasize a cautious data-dependent approach to any further easing. Powell is likely to acknowledge recent signs of softer hiring while noting that inflation remains elevated. The baseline outlook anticipates an additional 50 basis points of easing in 2026, delivered through 25 base point cuts in March and June, which will bring the target range to 3 to 3.25%. Bank of America, they said that the Fed has signaled it will cut rates by 25 basis points at the December meeting, and analysts expect 2 or 3 notable changes in the statement. First, the description of labor market conditions will likely drop the phase that unemployment rate remained low, given the 32 basis point rise over the past 3 months. Second, forward guidance language may be adjusted to show that the bar for additional cuts has risen, offering something to the hawks. One option is adding the word any, as in considering any additional adjustments, while another more dovish variant would reference the extent and timing of adjustments, return to language used early in the year when the Fed was pausing but still anticipating more easing. So their rate strategists also expect the Fed to announce term repo operations and reverse management purchases, or RMPs, beginning in January. While they see odds of an IOR cut, they assign higher odds of a parallel reduction in both interest on reserves and standing repo facility rates. It's going through the final bit of the investment bank research stuff from Credit Agricole. They say the official call is still that the Fed will remain on hold at the December FOMC, although the authors admit they are likely to be wrong, with a good chance the Fed delivers another 25 base point cut. After the October meeting, the call was looking good as hawks were in the ascendance, but they later ceded the spotlight to doves led by Fed's Williams, causing an abrupt shift in market pricing. The Fed's aversion to surpassing markets and the lack of pushback likely suggests it is teeing up another 25 base point cut. Still, divisions on the FOMC have not gone away. There is a substantial group that would support a hold, possibly even a majority, though the permanent voters skew more dovish than the rotating regional presidents. If a cut happens, it will likely be presented as a hawkish one, with Powell stressing that nothing is guaranteed and possibly hinting at a slowdown in the pace of easing. One thing to watch is whether the statement reinserts the phrase extent and timing to describe additional adjustments language that has generally coincided with a more cautious approach. The dot plot medians may come in unchanged, implying one cut in 2026, one in 2027, and none in 2028. Although there is a risk that they shift to 2 in 2026 and none in 2027 to 2028, which will be the same total amount of easing. For the S&P, limited change is expected given limited data since the last meeting, and inflation projections could come marginally down for 2025, but should still be around 3%. Just seeing here now, 17 counterparties take $5.045 billion at Fed reverse repo operation.
Just shy of
Hassett
40 minutes
says
away.
futures expect the Fed will cut by 25 basis points. So White House economic advisor Hassett currently speaking on Fox News.
Just about a little short of 40 minutes away from the Fed rate decision. Press conference coming up shortly thereafter. We'll be covering both of those live here. And biggest thing that I'm looking for is more color on whether we're going to see bill purchases from this Fed beginning next year. There's been some talk of increasing that to 45 billion a month from about 10 billion a month. A lot of this is from shifting where different parts of their balance sheet are maturing and what they're buying with that freed up capital. And we do see a lot of bill issuance from the government. We also see near-term liquidity conditions becoming tighter. So this is something the Fed's spoken to, and that's prompted bank analysts to say, well, maybe we're going to see an increase in bill purchases to ease some of those liquidity constraints. I believe we'll see a 25 bips cut, but the SEP is going to give us more color as to where members are in that dot plot for cuts next year. We're likely looking at only another 50 bips of cuts being priced in next year. Anything that meaningfully deviates from that in the SEP and Powell's talk will likely have an impact on both rates and risk assets. So that's another area to keep a close eye on. And then I think it's going to be important to get a sense as to really what the plan is for the balance sheet. It seems like at this point they're content to keep it pretty large. We've seen QT stop. We're probably closer to the next episode of QE than the next episode of QT, meaning we may actually see the Fed start to expand their balance sheet again if the economy slows next year and we see the labor market start to crack, especially under a new Fed chair. Powell, I don't see being particularly enamored about expanding the balance sheet. But the next Fed chair, who's likely to be more under the thumb of Trump, and the basis is let's stimulate, let's run things hot, we could see a combination of additional rate cuts and balance sheet expansion under their stewardship. So something to keep an eye on when a potential shadow Fed chair takes the helm as early as January and begins to speak about their agenda ahead of Powell's forced retirement in May.
unchanged from the prior 3.125%. Median rate forecast for current year unchanged at
Aggressive absorption
3.65%.
detected in S&P
Median rate
futures by
forecast for
buyers.
next year unchanged at 3.375%. A median rate forecast for next 2 years unchanged at 3.125%. And then finally, the rate forecast for the long run at 3.125%, prior 3%. Rajapal adds a bias ultimately toward lower yields heading to year end. US Commerce Department says it will release an updated estimate of US Q3 GDP on January 22nd. JP Morgan's Michelle says that the Fed will absolutely keep growing its balance sheet.
Just a few minutes out from the Fed cut, you can see liquidity conditions are diminishing as the order book darkens, showing there's less bids and offers near price.
Generals Rajapal says inflation.
And you can see also there's a very noteworthy large bid just below around 68.40, 670 contracts or so on bid there. That order has not disappeared as we approach this event volatility catalyst that is likely a 25 bips cut, potentially some buying back of near-term debt to be effectuated early next year, and some additional color from the SEP report that will also come out with the rate decision and Powell will present on during this press conference about where the Fed sees inflation, the economy, unemployment, and their interest rates going into next year. Stay tuned.
Societe Generale's Rajapal says the economy has been extraordinarily strong. US Commerce Department says the advance release on Q4 GDP, originally set for January 29th, will be rescheduled. One minute ago now, we'll lead with the US interest rate decision. Remember, expectation is for a 25 base point cut to 3.75% from 4%. Ten seconds. Cut, 25 base point cut, 25 base point cut to 3.75% as expected. Fed says it will begin Treasury bill purchasing on December 12th, and Fed medium projection maintains 25 base points of rate cuts in 2026. Fed says Schmidt Goolsbee dissent in favor of no rate change. Fed will consider extent and timing of additional adjustments. Fed says it will buy $40 billion of Treasury bills in the next 30 days. Seeing some movement towards the downside on the Dixie. Treasury is holding gains after the expected Fed rate cut with dissent. Seeing here then, Fed projections apply 25 basis points of rate cuts in 2026 and another 25 basis points in 2027. Projections show wide divergence of views for appropriate path of rates in 2026 and beyond. Fed policymakers see 4.4% unemployment rate at the end of next year versus 4.4% in September projections. Policymakers see end 2026 PC inflation at 2.4% versus 2.6% in September. Core seen at 2.5% versus 2.6%. Policymakers see 2.3% GDP growth next year versus 1.8% in September, and they see longer run growth at 1.8% unchanged from September. Fed median core PCE projections at 3% in 2025 and 2.5% in 2026. So Fed median view of Fed funds rate at the end of 2025 seen at 3.6% versus unchanged from the prior. Median view of Fed funds rate at the end of 2026 seen at 3.4% unchanged from the prior. Median view for 2027 seen at 3.1% unchanged from the prior. And median view of Fed funds rate at the end of 2023 at 3.1% also unchanged from the prior. Fed median view of Fed funds rate in the longer run at 3%, unchanged from the prior as well. So all those Fed median rate forecasts coming in as expected, except the longer run, which came in at 3% compared to the lower than the expected 3.125%. US federal budget balance minus 173 billion, higher than the expected minus 195 billion. Also, the Fed ends operational limit on standing overnight repo operations. And Fed says pace of future reserve management purchases likely significantly reduced. So also further from this, then the Fed are attentive to risk on both sides of dual mandate and judges the downside risks to employment have risen. Fed will begin reserve management purchases of Treasury bills beginning December 12th. The Treasury bill buying to be elevated for a few months. Uncertainty about the outlook remains elevated. Inflation has moved up from earlier in the year and remains somewhat elevated. Fed adds the economy has been expanding at a moderate pace, job gains have slowed, and unemployment rate has edged up. Fed signals rate cut pause by adding extent and timing to describe its approach to additional adjustments to policy rate. So just to tally the votes then, a vote in favor of policy decision was 9-3, with Myron preferring half percentage point cut and Goolsbee and Schmidt preferring no change. Also seeing the S&P 500, it did see a move towards the upside here, continuing to climb off of the back of the rate decision and the SEP. And the FMC rate statement and dot plot have been put on the feed for you to read through as well. So JP Morgan's Michelle giving a live review says Fed forecasts for economy seem to have a hawkish tilt.
Aggressive absorption detected in S&P futures by sellers.
So we were looking for a potential hawkish rate cut. That does seem to be what we got. That is to say, the dot plot shows only 25 bips of cuts next year. Fed funds futures were looking for 50. 4 officials are saying they could see 50 bips of cuts. 7 officials are saying none. I posted the dot plot out on my Twitter feed. And basically, this decision takes away some of the uncertainty about what the market was looking for. Obviously, I don't think the market's going to take the hawkishness of the dot plot very seriously with the new Fed chair coming in as early as May next year and likely to be a shadow chair of the Fed as of January. That is to say, Powell's vision, his narrative for the Fed isn't going to carry as much weight if you've got his successor speaking in different terms about where he sees the Fed going. I think that's one reason that the market is rallying in the face of a somewhat hawkish cut and a more conservative dot plot than what was being priced in. I think the other thing is the market's breathing a sigh of relief because liquidity conditions are easing with these bill purchases being authorized by the Fed to start on December 12th. We're looking at $40 billion of treasury bills being bought over the next 30 days, and that may continue. So that would be helping to ease some of that near-term liquidity. That's an elixir for the market. That's certainly something that more participants were looking for, probably beyond the rate cuts of next year, was are we going to see a little bit of relief on the short end? And we are. So I think markets can rally into that a bit, as well as the notion that Powell his tenure is short-lived and in effect really ends in January as a shadow Fed chair kind of comes in and essentially says, this is what my vision is from the June meeting forward. So some interesting tidbits to digest. The press conference with Chair Powell coming up in 22 minutes. And we'll be carrying that live. And then after the market closes, also be covering Oracle earnings, which are going to set the tone for what we can expect for the generative AI growth narrative. So I don't think we got anything particularly new. The SEP report, a little more conservative than what people think, but willing to brush that off with the new Fed chair coming in. Everyone expected 25 bips of cuts. That was about 90% priced in with Fed funds futures. And, the bill purchasing was already talked about in advance from Bank of America being a potential outcome. It's now become a surety, and whether that goes on an ongoing basis is yet to be determined, but it likely will to ease liquidity conditions. So let's stay tuned for the press conference. My preview for the Fed that I put out yesterday looking pretty much on point, that we're going to get a rally into the decision. And then we have the press conference from Jerome. He is probably going to come out a little more hawkish, being a little more indecisive about future cuts, which is what we're already seeing in the SEP report, basically saying, we're no longer in restrictive territory. We're pretty close to where we need to be. I expect to hear some of that, some concerns about the stickiness of inflation, some talk about the labor market slowing but not breaking, and Powell trying to kind of navigate that tightrope between overdoing it with cuts and not doing it enough. I do think there's still some chance that the markets could sell into his press conference. And ultimately, it really takes about 2 days after the Fed decision for everything to be digested and priced in, the sort of changes, especially after one of these SEP meetings where you have the summary of economic projections giving a more detailed look ahead. This happens every quarter. The last one was in September. There wasn't a lot that changed in this report in terms of what the Fed's outlook is, particularly for their interest rate outlook going through next year.
Seeing the S&P 500 last up 0.38% after the Fed rate cut, and the common Fed median projection maintains 25 basis points of rate cuts in 2026. Seeing the Nasdaq turning positive now, last up 0.06% after the Fed rate cut. And according to an official, they say US took law enforcement action on ship near Venezuela. So 2 US officials said the US had seized an oil tanker off the coast of Venezuela. Bipartisan Attorney General warned delusional AI chatbot outputs may violate state laws, according to a letter. So Meta, Apple, Microsoft, and Google and OpenAI among 13 companies that received warning letter. So again, there's Meta, Apple, Microsoft, Google, OpenAI among 13 companies that received a warning letter for warning delusional AI chatbot outputs may violate state laws. Ten minutes away from the bottom of the hour, expecting the press conference with Powell. We'll pop out the video on the feed for you as well. Deutsche Bank's Losetti says there was scope to get more dissents. We have popped out the video of the press conference again. That's due at the bottom of the hour for you to watch. An EU official says discussions between the US and the EU over tougher sanctions on Russia are ongoing. Deutsche Bank's Losetti says baseline expectation is the next move is a cut. So again, there's Deutsche Bank's chief US economist Losetti. Five minutes ago now to be at the press conference with Powell. Video is on feed. So also in regards to the reserve management purchase operations from the Fed statement, we'll pop that out on the feed for you as well to have a read through. So reminder, you did have the Fed that said they will buy $40 billion of treasury bills over the next 30 days. In that piece we just put out, it explains in a bit more detail what that looks like. That's from the New York Fed. JP Morgan's Michelle says this is another risk management adjustment policy. Surely expected to hear from Powell. Remember the videos on the feed.
We'll be going to the press conference live here, muting live audio headlines during the duration of the press conference and then resuming. And stay tuned afterwards for Oracle earnings this evening.
Voice news disconnected.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although important federal government data for the past couple of months have yet to be released, available public and private sector data suggests that the outlook for employment and inflation has not changed as much since our meeting in October. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a quarter percentage point. With today's decision, we have lowered our policy rate 3/4 of a percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement, or repo operations, are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning, and should be used when economically sensible. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Howard.
Thank you. Howard Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it is it's partly that consumer spending has held up. It's been resilient, and it to another degree it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive. And as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
Steve.
Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here, and have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have, if you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment and the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down, and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing. But that's certainly the implication.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the 2 official dissents against the cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our 2 goals are a bit in tension, right? So interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you, ultimately where do you think the bigger risk is, and it's very unusual to have persistent tension between the 2 parts of the mandate, and when you do, this is what you see, and I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views, and we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and And that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey, we're going to look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. I mean, you talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions, and you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I mean, I could make that case. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read. But in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did two discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3, is not a big data set. But you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the, notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now, and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Claire.
Claire Jones, Financial Times. A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would say point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story, that that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things, and we say that this was a decision to make. It obviously wasn't unanimous, but overall that was the judgment that we made, and that's the action we took.
Just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in reserves, in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant, as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20–25 billion per month. So that's a small part. That's going on. It's also happening in the context of a temporary few-month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Andrew.
Thanks, Mr. Chairman. This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew. You know, we're not legal commentators. It's before the courts, and we think we don't think that we help matters by trying to engage as a public discussion of that. I'll give you a mulligan, though.
No, thanks. I don't know if that means I get 3 questions, but
no, just one more.
I guess I wanted to come back to the 1990s question, and like, do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but you know, this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our 2 goals. And so that's just unique in my time at the Fed, and I think going back a long ways, we haven't had that. In our framework, as you know, says that when that's the case, that we try to, you know, take a balanced approach to the 2 things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really, but it just tells you you've got to. And I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral, because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say, and that's what we're doing now. It so happened that we've cut 3 times. That, you know, we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs.
Edward.
Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process that we're looking for that to end? And then because of that, is jobs the threat to the economy?
So with tariff inflation, you know, there's the announcement of a tariff, and then there's, you know, they start to take effect, and then it takes some months. Goods may have to be shipped from other parts of the, you know, it may take, you know, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. You know, we haven't been able to predict this with any precision. No one is. But call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this. And after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I want to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman. Does that hinder your current job right now or change your thinking at all?
No.
Mike.
No mulligans for it. Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got to, when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very, you know, that's one part of it is inflation compensation break-evens. And, you know, they're at very comfortable levels. They're at levels consistent. Once you get out past the very short term now, break-evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be, an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation as their #1 concern. Can you explain
aggressive absorption detected in S&P futures by sellers?
The labor market, which seems relatively stable to most people, instead of their #1 concern, inflation?
So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal, and our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money, and we're going to need to have some years where real compensation is higher, it's positive, significantly positive, so nominal wages are higher than inflation, for people to start feeling good about the affordability issue. And, so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages so that people are earning enough money and feeling economically healthy again.
Victoria.
Hi, Victoria Guida with Politico. Just to follow up on that, I mean, this is now the third time that you've cut this year and inflation is around 3%. So is the message that you're sort of trying to send with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2% because inflation is relatively stable where it is?
Everyone should understand, and the surveys show that they do, that we're committed to 2% inflation, and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now, supply of workers has also gone way down, so the unemployment rate hasn't moved that much. But
aggressive absorption detected in S&P futures by sellers.
Downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work. So that's really important to people. The story with inflation, and we're well aware that this is a story at this point, is that if you get away from tariffs, inflation is in the low 2s, right? So it's really tariffs that's causing most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry about the labor market, because the labor market unemployment was very low. If you remember when inflation was very high, there was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both, and I think we're doing the best we can for people. They also care about their jobs. They do care about affordability, and the best thing we can do there is both to support economic activity, but also, make sure that when tariff inflation goes down and disappears, inflation lands around 2%.
Elizabeth.
Thanks so much, Elizabeth Schulze with ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Oh, well, we know, I think it's I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody. They have a survey. And there's been something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. And that was exactly what happened. So we think that has persisted. And so there's an overcount in the payroll job numbers, we think, continuing, and it will be corrected. I don't have the exact month in my head right now, and that's just, again, I think forecasters generally understand that. So, and we think it's about 60,000 a month, so 40,000 jobs could be negative 20, and that could be wrong by 10 or 20 in either direction. But
aggressive absorption detected in S&P futures by sellers.
Job creation, in a way, that's demand. Labor supply has also come down quite sharply. So, if you had a world where there's just no growth in workers and you really don't need a lot of jobs to have full employment, some people argue that's what we're looking at. But I think a world where job creation is negative, I just think we need to watch that situation very carefully and be in a position where we're not, pushing down on job creation with our policy.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be. But, for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance, and since job creation, job finding rates are extremely low. If there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up. It really haven't much, so it's a little bit curious. But longer term, though, the question is, what are we going to see here? And we don't know, but it's it may be that in past really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
Enda.
Thank you, Chair. Enda Curran, Bloomberg News. Given the breadth of views on the policy committee, why is there such a division of views between
the policy what? On
the committee?
Thank you.
Why is there such a division of views between the presidents and the board members?
It's not so stark as that. The views are more varied in each group as well. There's some of that, but I would say they're also governors and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
Christine. Thank you.
Thank you, Chair Powell. Christine Romans, NBC News. I wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy, and what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that, asset values, housing values, and securities values are high, and they tend to be owned by people more at the higher end of the income and wealth. So as how sustainable it is, I don't know. Most of the consumption does happen by people who have more means. I think the top third accounts for way more than a third of the consumption, for example. So it's a good question how sustainable that is. The best we can do is to have a price stability and a strong labor market. And what we saw, for example, what we saw at the end of the very, very long expansion that ended with the outbreak of the pandemic, we saw that it was 10 years and 8 months or something like that, the longest one in recorded history. In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income. So, having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record.
Yeah, so the housing market faces some really significant challenges. And I don't know that, a 25 basis point decline in the federal funds rate is going to make much of a difference for people. Housing supply is low. Many people have very, very low rate mortgages from the pandemic period, and they kept refinancing and caught the really low. So it's made it expensive for them to move. And we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time, and so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem, and really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address a secular housing shortage, a structural housing shortage.
Chris.
Thanks. Chris Rugaber, Associated Press. You mentioned on inflation, services inflation being low, goods inflation looking like maybe it'll peak. We had the wages report you mentioned today showing moderating wage growth. Where are the inflation risks? It looks like inflation is cooling, in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk in inflation is pretty clear to see, and that is, we see higher inflation. As I mentioned, most of the inflation over target is from goods. And we estimate, we expect, most of us, that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected. Is that going to happen now? That's the risk. The risk is either that tariff inflation just turns out to be more and more persistent, maybe because companies who are now holding back from passing through the tariffs will just keep doing that. So you see that. I think the other possibility is less likely, and that is just that the labor market gets tight or the economy gets tight, and you see just traditional inflation. I don't see that as particularly likely. But so I think again, all across the committee, people see the picture pretty similarly, but see the risks quite differently. And some people do see the inflation risk, and I wouldn't dismiss that case. I don't dismiss that case, but you've got to make an assessment, and this is the assessment we made.
Hi, Chair Powell. Neil Irwin with Axios. So this has come up a couple of times today, but to be clear, do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had 5-6 years of 2% productivity growth. This is higher. This is definitely higher, and it was before it could be attributed to AI. I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes people who use it more productive. It may make other people have to find other jobs, though. So it could have productivity implications while also having social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity. I think it's a little quick to be saying it's generative AI, but I don't know. The pandemic may have induced people to do more automation and do more things with computers to replace people, and that raises productivity, output per hour.
Does that imply a higher neutral rate, and therefore the policy might be a little easier than it seems?
All things equal, yes, but all things aren't equal. There are many things pushing in different directions on where the neutral rate would be. But yes, that argument does come up.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. After today, you only have 3 more meetings at the helm of the Fed. Since becoming Fed chair, you've seen multiple trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
My legacy. My thought is that I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong. That's what I want. And all of my efforts are to get to that place. They have been all along, but ultimately
aggressive absorption detected in S&P futures by sellers.
Bigger things. I hope many years ahead to worry about that, but there's enough to do.
Relatedly, have you given any more thought, and can you tell us any more about your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
Again, I'm focused on my remaining time as chair. I haven't got anything new on that to tell you.
Go to Mark for the last question.
Chairman, Mark Hamrick with Bankrate. Even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates, or yields to be more precise, have peaked while key borrowing rates remain elevated. And that's, as we've discussed here, as many Americans struggle with liquidity or emergency savings challenges. Is that just collateral damage or an unintended consequence because your tools are limited in addressing individual or household liquidity constraints, insufficient money in the bank?
I don't know. I wouldn't agree that that's collateral damage of our. I mean, over time, we do what we do in order to create price stability and maximum employment, and those things are hugely valuable to all the people we serve. When we raise rates to bring inflation down, that does work by slowing the economy, but we've moved back our policy back down to where it's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave. Sort of every large economy in the world, sort of every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth, we had better labor market, and this is really due to the American economy. We have an extraordinary economy, and people are innovative, they work hard, and so we're all of us who work in economics jobs are really fortunate to have the U.S. economy. So, thank you very much.
And that was the press conference with Chair Powell. Overall, a relatively mixed press conference, some hawkishness in terms of rates, some dovishness in terms of how they're going to manage their balance sheet, in particular with regards to these short-term Treasury security purchases or T-bills. Market rallied to the hot call during the press conference, but we did see sellers repeatedly coming in and absorbing just above 6,900, just around that hot call. So there does seem to be some supply up here to be aware of. We may get a little bit of a fade and consolidation from here during the last half hour of trading. And again, with the Fed, you've got to give it at least 2 trading days to digest, because a lot of the reaction function that you see during the decision and press conference are high-frequency trading algorithms rather than human traders shifting up positions in light of what they've heard and what they think that may do to change their overall portfolio allocation. So I would be looking at this as initially a pretty hawkish cut overall, but on the dovish side, you do have Fed coming in to ease liquidity conditions in the Treasury security market. And overall, that's well received by the market. I think that is actually more important in the near term than what the rate cutting trajectory looks like next year, given that Powell is going to be replaced. And again, likely to have a shadow Fed chair as early as January. Whenever Trump makes that announcement, whomever is picked is likely to begin discussing what it is that they're looking for in terms of policy, in particular interest rates.
Aggressive absorption detected in S&P futures by buyers.
So I'm going to get ready for Oracle earnings. We'll also be writing up some more detail about what we saw from the Fed. So expect some more color on that from Aisha and I in the next day or two for Traderade members. And stay tuned here, as we'll be covering Oracle earnings that are going to be coming out after the bell here this evening.
Bank of America CEO Moynihan says, I don't see indications of consumer stress. And Trump says, we'll approve plant constructions in a matter of weeks. The Canadian dollar extends gains, touching its strongest level since September 22nd. That's against the US dollar. Trump says, I don't see why we can't have 20 to 25% GDP growth. And Trump says the market should continue to go up with great results. So Trump saying we should be able to do more than 3 or 4% GDP. Reiterates criticisms of Fed's Powell as well. Trump says the rate cut was a small number that could have been more. Trump says Switzerland was paying almost nothing, and now they are paying a fair amount. Trump says the Fed rate cut could have been doubled. Trump says you can have tremendous growth without inflation. Treasury yields extend slide, the 2-year down 8 basis points on the day. Dell says we had a great meeting earlier with US Energy Secretary Wright. Chevron says that operations are not disrupted by the US tanker seizure. IBM CEO asks Trump to reduce controls on certain countries. 1 minute now until we get the market on close imbalance. Ten seconds. Market on close imbalance, S&P 500, sell side 542 million, Nasdaq 100, buy side 433 million, Dow 30, sell side 387 million, Mag 7, buy side 456 million.
Coming up after the close, earnings from ORCL. Oracle expecting $1.64 adjusted earnings for ORCL. ADBE Adobe, $5.39. That coming up after the close. Benzinger market update. S&P futures up 51.50. The Dow futures up 556. Nasdaq up 142. Crude is up 69 cents, 58.94. Gold is up $29 at 42.6510. Bitcoin futures up 245 at 93,585.
Large buy iceberg ESC5 CME at 6,898.25.
President Trump on Ukraine call with European leaders has discussed in pretty strong words. They would like U.S. to go to a meeting in Europe on the weekend. We'll make a determination based on what they come back with. Meeting with Zelensky and U.S. is what is being requested. Ukraine hasn't had an election for a long time. President Trump said, I think CNN should be sold. That's WBD. Trump says in any deal, it should be guaranteed that CNN is part of it or sold separately. CNN should be sold along with everything else.
In 10 minutes' time, we're expecting Oracle's Q2 2025 earnings. Estimated EPS $1.68, estimated revenue $16.21 billion.
Aggressive absorption detected in S&P futures by buyers.
NYSE, MyCM, has received notice of allowance for U.S. patent secure messaging with digital rights management using blockchain technology. That's Michael Yankee Sandy Echo. Less than a minute to the close. Trump said rates should be the lowest in the world. ASYS Amtech Systems reporting less than a penny in earnings. Alpha Sandy Yankee Sandy. The estimate was a loss of 3 cents, so that's better than expected for ASYS. Teva at the highs now, TEVA. Coming up, earnings from Adobe and Oracle, ORCL, ADBE. Amtech, the adjusted number was 10 cents, so that's a beat for Sandy Yankee Sandy. RYTM, Rhythm Pharmaceuticals, announcing a preliminary phase 2 data for setmelanotide and Prader-Willi syndrome. That's Romeo Yankee Tango Michael, RYTM. CRBP, Corbus Pharmaceuticals, to report results from phase 1A study of oral CB1 inverse agonist CRB913 to treat obesity on Thursday, December 11th. That's tomorrow. That's Charlie Romeo Bravo Papa. Oracle expecting a $1.18 gap, $1.64 adjusted earnings. That's ORCL. Also, Adobe expecting $4.31 gap, $5.39 adjusted earnings. ADBE, Adobe, or Oracle first. Oracle, $2.26. The estimate on Oracle was $1.64. That's a beat. Revenue of $16.1 billion. The estimate was $16.2 billion. So that's a beat on earnings. Revenue coming in a bit short for ORCL, Oscar Romeo Charlie Lima. ADBE, Adobe reporting $5.50. The estimate $5.39 adjusted. So that's a beat. Revenue $6.19 billion. The estimate was $6.107 billion. That's a beat for ADBE. Adobe sees full-year adjusted earnings of $23.30 to $23.50. Sees Q1 earnings of $4.55 to $4.60, adjusted $5.85 to $5.90 for ADBE. PSTG Pure Storage announcing a share buyback. Papa Sandy Tango Golf, $400 million. PSTG. SNPS Synopsys reporting $2.39. The estimate on Synopsys was $2.78, so that's a beat for SNPS. PSKY and WBD, Paramount Skydance, says our offer is financially superior to Netflix's transaction. For WBD, that's PSKY and Whiskey Bravo Delta November Foxtrot Lima X-ray. Oracle will buy the latest GPUs from NVIDIA. Will continue to buy the latest GPUs from NVIDIA. NVDA. Shares of NVIDIA, though, are falling here. It says need to be prepared and able to deploy whatever chips our customers want to buy. NVIDIA shares continuing now, 182.24, falling here following those comments from Oracle. Oracle committed to a policy of chip neutrality with all CPU and GPU suppliers. So that's causing NVIDIA to fall now. Shares of Oracle moving lower now, 218, down about $5 on Oracle or RCL. Continuing to fall here, about $11 now.
So I'll just say I don't really like what we're seeing from Oracle here. The results were at best mixed. We've got a bottom line beat, but top line growth slower than expectations, missed on operating income and margin. Software revenue came in light. And the performance obligations are much higher than what was expected. A lot of that probably related to AI CapEx. But overall, the market reaction negative here, down about 7% on Oracle. We talked a little earlier about a put wall around 200 when I posted the earnings preview. That's going to be a pretty decisive area to watch for Oracle. If it's not able to hang on to 200, we could see this thing continue to move down over the next couple of weeks. I think on a very, very long term, if you zoom out, these bigger dips in Oracle are usually worth buying, but you've got to wait for the dust to settle first. So for now, we're going to watch how this is digested, listen to the earnings call, but I think this is one where you've got to wait for it to bottom out if you're wanting to bid into this downward move.
With the authorization of new treasury purchases to replenish bank reserves, help traders to look beyond a minor
PL
lowering of
Planet Labs
expectations
reporting
for
a loss of 19 cents. The estimate a loss of 7 cents, or wider loss than expected for PL, Papa Lima. MTN Vail Resorts, a loss of $5.20. That's wider than the $5.05 loss that was expected for Michael Tango November. GRI, Gree Bio, announced top-line data from its phase 2A study in idiopathic pulmonary fibrosis. That's Golf Romeo, India. STC, Steward Information Services, filed for mixed shelf size not disclosed, Sandy Tango Charlie. FF Future Fuel extended previously authorized share buyback program of up to $25 million for additional 24 months to expire in March 2028. That's Foxtrot. SCR Serena Therapeutics submits complete response to the FDA clinical hold letter for SCR 252 program. That in the filing, San Diego Romeo, SCR. BMY, Bristol Myers Squibb, announced a dividend increase from 62 cents to 63 cents. That's Bravo Michael Yankee. AARD, or Aardvark Therapeutics, regulatory clearance for enrollment by clinical trial sites in Canada and the UK has been received. That's Alpha Alpha Romeo Delta. First patient was dosed in Australia in the HERO Phase 3 trial for Prader-Willi syndrome. That's Alpha Alpha Romeo Delta. Oracle shares right now off the lows at 209.91. Down about $13. That's Oscar Romeo Charlie Lima. ADXN, ADX Therapeutics, files prospectus to offer and sell ADSs for up to $3.3 million from time to time. That's Alpha Delta X-ray November. HOOD, Robinhood Markets, total platform assets at the end of November of $325 billion. That's Hotel Oscar, Oscar Delta. ODC, Oil Drive Board of Directors, announcing a 14% increase in quarterly dividend. That's Oscar Delta Charlie, ODC. NDSN Nordson reporting $3.03. The estimate $2.93. That's November Delta Sandy November. Sales of 751.8 million. The estimate 765.4 million. So that's beat on earnings, a miss on sales for November Delta Sandy November.
Oracle's earnings calls coming up in just about 27 minutes here. Stock is trading close to the lows after hours. Remember, we've got strong put-driven support around $200, and the options implied move was plus or minus 10%, which is in line with the average move for this company.
In 10 minutes time now at 4:45 p.m. Eastern Time, get the New Zealand manufacturing sales. The prior was minus 2.9%. In 5 minutes time now at 4:45 p.m. Eastern Time, get the New Zealand manufacturing sales with a prior of minus 2.9%.
One minute to go now to get the New Zealand manufacturing sales. Ten seconds. Once put 1%, once put 1%.
Large buy iceberg ESC5 CME at 68.94. Aggressive absorption detected in S&P futures by buyers.
Delia, Chief Executive Officer Clay McGurk, and Principal Financial Officer Doug Caring. A copy of the press release and financial tables, which includes a GAAP to non-GAAP reconciliation, other supplemental financial information, and a list of many customers who purchased Oracle Cloud Services or went live on Oracle Cloud recently, will be available from our Investor Relations website. As a reminder, today's discussion will include forward-looking statements, and we will discuss some important factors relating to our business. These forward-looking statements are also subject to risks and uncertainties that may cause actual results to differ materially from statements being made today. As a result, we caution you from placing undue reliance on these forward-looking statements, and we encourage you to review our most recent reports, including our 10-K and 10-Q and any applicable amendments. And finally, we're not obligating ourselves to revise our results or these financial-looking statements. Before taking questions, we'll begin with a few prepared remarks, and I'll now turn the call over to Mike.
No, it's actually to me, Ken. Appreciate it. This is Doug. As it relates to the numbers we're about to present, the following apply to both the results for Q2 and to our guidance for Q3. First, we'll be discussing our financials using constant currency growth rates, as this is how we manage the business. Second, we'll be presenting our numbers on a non-GAAP basis, except where we indicate otherwise. Finally, as it relates to currency, it had a 1% positive impact on revenue and 3 cents positive impact on earnings in Q2. For Q3, assuming currency exchange rates remain the same as they are now, currency should have a 2 to 3% positive effect on revenue and have a 6 cents positive effect on EPS, depending on rounding. In terms of the results for Q2, we had another excellent quarter of execution. Remaining performance obligations, or RPO, ended the quarter at $523.3 billion, up 433% from last year, and up $68 billion since the end of August. driven by contracts signed with Meta, NVIDIA, and others as we continue to diversify our customer backlog. RPO expected to be recognized in the next 12 months grew 40% year over year, compared with 25% last quarter and 21% last year. Total cloud revenue, which includes both applications and infrastructure, was up 33% at $8 billion, representing a significant acceleration from the 24% growth rate reported last year. Cloud revenue now accounts for half of Oracle's overall revenue. Cloud infrastructure revenue was $4.1 billion, up 66%, with GPU-related revenue growing 177%. Oracle's cloud infrastructure businesses continue to grow much faster than our competitors. Cloud database services revenue was up 30%, with autonomous database revenue up 43% and multi-cloud consumption up 817%. Cloud applications revenue was $3.9 billion and up 11%. Our strategic back office applications revenue was $2.4 billion and up 16%. As we finish combining our industry-based cloud apps and our Fusion cloud apps under one selling organization in each region across the world, we have been seeing increasing cross-selling synergies that are expected to drive higher cloud applications growth rates in the future. All in, total revenues for the quarter were $16.1 billion, up 13%, and higher than the 9% growth reported in Q2 last year, continuing our trend of accelerating total revenue growth. Operating income grew 8% to $6.7 billion. Non-GAAP EPS was $2.26, up 51%, while GAAP EPS was $2.10, up 86%. We recognized a pre-tax gain of $2.7 billion in the quarter, stemming from the sale of our interest in Ampere. Turning to cash flow. Operating cash flow in Q2 was $2.1 billion, while free cash flow was a negative $10 billion, and CapEx was $12 billion, reflecting the investments being made to support our accelerating growth. As a reminder, the vast majority of our CapEx investments are for revenue-generating equipment that is going into our data centers and not for land, buildings, or power that collectively are covered via leases. Oracle does not pay for these leases until the completed data centers and accompanying utilities are delivered to us. Rather, the equipment CapEx is purchased very late in the data center production cycle, allowing us to quickly convert cash spent into revenues earned as we provision cloud services to our contracted and committed customers. In terms of funding our growth, there are a variety of sources available to us throughout our debt structure in public bond, bank, and private debt markets. In addition, there are other financing options through customers that may bring their own chips to be installed in our data centers, and suppliers who may lease their chips rather than sell them. Both of these options enable Oracle to synchronize our payments with our receipts and borrow substantially less than most people are modeling. As a foundational principle, we expect and are committed to maintaining our investment-grade debt rating. Turning to guidance. Let me start with the impact of the added RPO that occurred in Q2 on our future results. The vast majority of these bookings relate to opportunities where we have near-term capacity available, which means we can convert the added backlog to revenue sooner. The result is we now expect $4 billion of additional revenue in FY27. Our full-year FY26 revenue expectation of $67 billion remains unchanged. However, given the added RPO this quarter that can be monetized quickly starting next year, we now expect fiscal 2026 CapEx will be about $15 billion higher than we forecasted after Q1. Finally, we are confident that our customer backlog is at a healthy level and that we have the operational and financial strength to execute successfully. While we continue to experience significant and unprecedented demand for our cloud services, we will pursue further business expansion only when it meets our profitability requirements and the capital is available on favorable terms. As it relates to specific guidance for Q3, Total cloud revenue is expected to grow from 37% to 41% in constant currency, and is expected to grow from 40% to 44% in USD. Total revenues are expected to grow from 16% to 18% in constant currency, and are expected to grow from 19% to 21% in USD. Non-GAAP
Citi
EPS
Inc. Global
is
offering of
expected to grow
5.4 million
12%
shares.
to 14%, and be between $1.64 and $1.68 in constant currency, and grow between 16% to 18%, and be between $1.70 and $1.74 in USD. And with that, I'll turn it over to Clay.
Thank you, Doug. Our infrastructure business has grown at an accelerating 66% year over year. You are well aware of the strong demand for AI infrastructure, but multiple segments across OCI are also contributing to this accelerating growth rate, including cloud natives, dedicated regions, and multi-cloud. Our diversity of capabilities within infrastructure differentiates us from AI infrastructure neoclouds. Our unique combination of infrastructure and applications differentiates us from other hyperscalers. We have ambitious, achievable goals for capacity delivery worldwide. OCI now operates 147 live customer-facing regions with 64 more regions planned. In the last quarter, we handed over close to 400 megawatts of data center capacity to our customers. We also delivered 50% more GPU capacity this quarter than Q1. Our supercluster in Abilene, Texas is on track with more than 96,000 NVIDIA Grace Blackwell GB200s delivered. We also began delivering AMD MI355 capacity to customers this quarter. Our pace of capacity delivery continues to accelerate. We continue to see strong demand for AI infrastructure across training and inferencing. We follow a very rigorous process before accepting customer contracts. This process ensures that we have all the necessary ingredients to deliver to customer success at margins that make sense for our business. We analyze land and power for data center buildings, component supply, including GPUs, network gear, and optics, labor costs for all phases of construction and low voltage work, engineering capacity to design, build, and operate, revenue and profitability, and capital investments required. Only when all these components come together do we accept customer contracts, having the confidence we can deliver on schedule with the highest quality. As Doug said, this quarter we contracted for an additional $68 billion of RPO. These contracts will quickly add revenue and margin to our infrastructure business. We continue to carefully evaluate all future infrastructure investments, investing only when we have alignment across all necessary components to ensure profitable delivery for our customers. The holiday season is peak period for many of our retail and consumer customers. It is our responsibility at OCI to deliver the most secure, highest performance, and highest availability infrastructure to support these customers at the scale they need. Uber has now surpassed 3 million cores on OCI, powering their highest traffic ever this Halloween. Temu scaled to nearly 1 million cores for Black Friday and Cyber Monday. In addition, we also supported thousands of other customers across our retail and other applications through their largest and most successful holiday period yet. OCI is constantly expanding in features and services. We recently launched Acceleron, delivering enhanced networking to all OCI customers, and other services like our AI agent service. However, we cannot deliver everything ourselves, and we rely on our rapidly expanding partner community to provide the best experience on OCI. We added new AI models from Google, OpenAI, and xAI to ensure our customers have the latest and greatest AI capabilities. Our marketplace consumption has grown 89% year over year, powered by partners like Broadcom and Palo Alto. Those same partners drive OCI consumption by building their SaaS businesses on OCI. Palo Alto released their SASE and Prisma Access platform on OCI, and Cybereason and Newfold Digital continue to scale their businesses rapidly. These partnerships make our ecosystem richer, which helps our customers, and that growth translates directly into more OCI growth as our partners build their solutions on our infrastructure. Oracle Database Services see increasing demand across all clouds. Multi-cloud database consumption has increased 817% year over year. We launched 11 multi-cloud regions this quarter, bringing us to 45 regions live across AWS, Azure, and GCP, with 27 more planned over the next months. We see increasing customer demand with billions in identified pipeline. we launched two important programs this quarter for multi-cloud. The first is Multi-Cloud Universal Credits, which enables customers to commit once to Oracle database services and use them anywhere in any cloud with the same price and flexibility. The second is our Multi-Cloud Channel Reseller Program, which enables customers to procure Oracle database services through their preferred channel partners. We also launched 9 services across the different clouds, such as Oracle Autonomous AI Lakehouse. This combination of the best services, universal availability, consistent and easy pricing and procurement, and partner support is accelerating the adoption of Oracle database services across our entire customer base. OCI is the only full cloud available to individual customers. We launched Dedicated Region 25, which provides the full capability of OCI in a tiny 3-rack footprint. OCI is also the only cloud that enables partners to become cloud providers themselves through our Alloy program, and our new footprint is available for all Alloy providers. Dedicated region and Alloy consumption grew 69% year over year. We launched one dedicated region for IFCA Group in Oman, and both NTT Data and SoftBank launched one Alloy region each this quarter. This brings our live dedicated regions to 39, with 25 more planned. In summary, the 4 segments of our infrastructure business are growing at incredible rates. This will contribute to a continued acceleration in our infrastructure revenue in the coming quarters. Customers are choosing OCI for its performance-optimized architecture, unrelenting focus on security, consistently low and predictable pricing, and unmatched depth in database and enterprise integrations. Those priorities have been our strategy from the beginning and are the driving force behind this growth. OCI is in a constant state of reinvention, and you can see the value that has for our customers. When you combine our commitment to deliver the best in performance, efficiency, and security with the growing customer demand for cloud infrastructure services we are seeing, I couldn't be more excited about what's coming next. And with that, over to Larry.
Thank you very much, Clay. Over the years, Oracle has developed software in 3 important areas: database, applications, and the Oracle Cloud. We used AI to make our database software and our autonomous software eliminates human labor and human error, thus lowering operating costs and making our systems faster, more reliable, and more secure. Now, with the development of the Oracle AI Database and the Oracle AI Data Platform, we're bringing all 3 layers of our software stack together to solve another very important problem: enabling the latest and most powerful AI models to do multi-step reasoning on all your private enterprise data while keeping that data private and secure. Training AI models on public data is the largest, fastest growing business in history. AI models reasoning on private data will be an even larger and more valuable business. Oracle databases contain most of the world's high-value private data. Oracle applications also hold huge amounts of exceptionally valuable private data. The Oracle Cloud includes all the top AI models: OpenAI ChatGPT, xAI Grok, Google Gemini, and Meta Llama. Oracle's new database and AI data platform, plus the latest versions of Oracle applications, enables all of those AI models to do multi-step reasoning on your database and application data while keeping that data private and secure. All our database and application customers want to do this because for the first time, they get a unified view of all of their data. AI models can respond to a single inquiry by reasoning across all your databases, all of your applications. By treating all of your data holistically, the combination of AI models plus the Oracle AI Database and AI Data Platform breaks down the walls that isolate and fragment your data. The Oracle AI Data Platform makes all your data accessible to AI models, not just Oracle databases and Oracle applications, the data in Oracle databases and Oracle applications, but data from other databases, cloud storage from any cloud, even data from your own custom applications are accessible to AI models using the Oracle AI Data Platform. Using our AI Data Platform, you can unify all your data and reason on all of your data using the very latest AI models. This is the key to finally unlocking all the value in all your data. Very soon, through the lens of AI, you will be able to see everything happening in your business as it happens. Mike, over to you.
Thanks, Larry. As Doug shared, the total revenue growth up 13% in constant dollars. I think it's worth noting that that's 3 consecutive quarters now where total revenue growth has been in double digits. So a solid quarter, and we see even better days ahead of us. So let me break down a few of the numbers a bit further, and I'll do so all in constant currency. Cloud applications revenue was up 11%, and that brings us to about a $16 billion annualized run rate. Within that, Fusion ERP up 17%, Fusion SCM up 18%, Fusion HCM up 14%, NetSuite grew by 13%, Fusion CX is up 12%. In our industry clouds, specifically hospitality, construction, retail, banking, restaurants, local governments, and communications all combined, we're up 21% in the quarter. So big growth rates on a big base. In our healthcare business, we now have 274 customers live in production on our clinical AI agent, and that number continues to rise daily. Also in healthcare, our brand new AI-based ambulatory EHR is generally available, and it has received U.S. regulatory approval. And finally, in healthcare, in Q3, we expect both our bookings and our revenue to accelerate materially. So overall, cloud apps were up 11% on a bigger base. This is very meaningful because we see this business as continuing to accelerate going forward. We achieved this growth while we also undertook a major Salesforce reorg in many regions throughout the world. This is something we've been talking about for many years, and that is the synergies between our back office applications and our industry applications. We're seeing more and more deals where our industry apps are pulling Fusion or the Fusion apps are pulling the industry apps. And as a result of seeing more and more deals, we're also seeing larger deals with more components. So recently, we combined our industry application sales team and our Fusion sales teams into a single selling organization. This enables our sellers to have more strategic one Oracle conversations with our customers to sell higher and to sell more. And then when you think about our very large install base of on-premise application customers, these strategic conversations are driving upgrades. And you've heard us say before, just moving a customer to the cloud results in a 3 to 5x annual revenue lift compared to the support revenue. Now, on top of all of that, top of the Salesforce, the one Oracle go-to-market motions, the industry suites, think about combining our AI data platform with this unmatched suite of applications. This creates an incredibly unique opportunity for our customers to gain value very quickly from enterprise-grade AI. The combination allows customers to unite the industry-leading foundational models with company-specific proprietary data, as Larry mentioned, much of which comes from the Oracle applications. And of course, the AI data platform also ties in non-Oracle applications, competitive data sources like MongoDB or Snowflake, object stores, and even complete bespoke unstructured data. So we think this allows our customers to very easily build enterprise lakehouses, AI agents, and applications that leverage built-in, not bolted on, but built-in AI to transform their business. So just to repeat, AI, of course, is a great OCI play, but it's also a broader software play for Oracle. It's driving growth in our applications and our database businesses as well. Let me highlight a few key wins. In communications, the communications industry, Digital Bridge Holdings selected ERP and SCM. Etihad Salam Telecom, SCM. Motorola Solutions, ERP, SCM, and CX. Tim Brazil,
who's the country of Brazil's 5G leader, just signed a new 5-year expansion to accelerate AI adoption and to transform customer experience at scale, all built on OCI. This 5-year deal was an extension of a partnership that began with TIM Brazil's full data center migration to OCI back in 2021. So they're now building AI agents that are powering real customer interactions, including the Conta agent, which compares bills for customers across months and explains variations automatically. Already in the pilot, 18% faster issue resolution with the AI agents built on OCI. Expecting even further improvements as the rollout continues. They've got 24 projects in motion. 7 of them are already in production in just a matter of months. 6 more launching soon, all enabled by a multi-cloud architecture with Oracle as the key AI infrastructure partner. Already, as a result of this initial rollout, customer satisfaction is up 16%, and call center flows are managing end-to-end with 90% accuracy, resulting in 30% faster services times for customers and a 15% fewer network failure interventions, all using predictive analytics and again, AI copilots built in OCI. So we are the AI engine for TIM Brazil to enable personalization at national scale. In financial services, Core Civic selected ERP, SCM, and HCM. Prime Life Technologies, ERP. Jewelers Mutual Insurance, ERP. In public sector, the City of Costa Mesa, ERP, SCM, HCM. The United States Space Force, ERP, and HCM. The City of Santa Ana, ERP, SCM, and HCM. In the high-tech industry, SolarEdge Technologies, ERP, and SCM. Zscaler, ERP. Dropbox, ERP, and SCM. I could go on and on about these wins, but I think it gives you the flavor of just the sheer amount of multi-pillar wins and why it's so important that we have so many different options for customers in back office and front office. In terms of go lives, we had 330 cloud apps customer go lives this quarter. That's multiple go lives per day. Virgin Atlantic Airways went live in September on Fusion ERP and HCM and payroll. Broadridge just recently relaunched their Fusion ERP and EPM go live. LifePoint Health just went live on their 3rd wave of Fusion ERP, SCM, and HCM. Saudi Telecom is live on Fusion SCM with ERP and HCM to follow soon. DocuSign is now live on Fusion Data Intelligence. Again, I could go on about the go lives with 330 of them in the quarter. Gives you a flavor of some of the really important go lives that we had recently. The cloud application deferred revenue is up 14%. That is higher than the cloud apps revenue growth of 11%. Just to reinforce my earlier statements that we expect continued apps growth acceleration. So a solid quarter across the board. We're on the back end of a sales reorg that was focused on unified selling across our applications portfolio. We're seeing a clear AI halo effect for our cloud applications, which is driving upgrades. Our AI data platform, combined with our applications, is an absolute conversation changer, and it brings the Oracle database and all of our applications into the center of the modern agentic enterprise. Looking ahead, we're executing well on a big and growing pipeline, and I expect revenue and earnings growth to accelerate off an even larger base. With that, Ken, I'll turn it back to you.
Mike, Tiffany, if you could please poll the audience for questions.
At this time, if you would like to ask a question, press star, then the number 1 on your telephone keypad. To withdraw your question, simply press star 1 again. We will pause for just a moment to compile the Q&A roster. Your first question comes from the line of Brad Zelnick with Deutsche Bank. Please go ahead.
Thank you. Congratulations and a particular shout out to Mahesh and the team for standing up a massive amount of capacity in this quarter. My question is for Clay or maybe Doug. Oracle is clearly the destination of choice for the most sophisticated AI customers, but this is a far more capital intensive proposition, unlike any business Oracle has ever been in before. Very specifically, how much money does Oracle need to raise to fund its AI growth plans ahead? Thank you.
Thanks for the question, Brad. This is Clay. So look, I'll answer that question in 2 parts. First, Let me give you kind of the reason why it's hard to answer that question exactly. So the thing I think that a lot of people don't understand is that we actually have a lot of different options for how we go about delivering this capacity to customers. There's obviously the way that people think about it, which is we buy all the hardware up front. And as I talked about at my financial analyst meeting, we don't actually incur any expenses for these large data centers until they're actually operational. So then it goes on to, well, how do you pay and what's the kind of cash flows look like for the stuff that goes into the data center? Well, we have some other interesting models that we've been working on. One of them is that customers can actually bring their own chips. And in those models, Oracle obviously doesn't have to incur any capital expenditures up front for that model. Similarly, we have different models that we're working on with different vendors, where some vendors are actually very interested in a model where they rent their capacity rather than selling that capacity. And as you can imagine, that comes with different cash flow impacts that are favorable and reduce the overall borrowing needs and capital required for Oracle. So as you can imagine, as we look at all of these kind of commitments, we will use a range and a variety of those such that we minimize the overall cost of capital, as well as, in certain cases, we raise our own funds. As part of that, I think it's important that everyone understand that we're committed to maintaining our investment grade debt rating. So now to give you some more specifics, what I would say is we've been reading a lot of analyst reports, and we've read quite a few that show an expectation of upwards of $100 billion for Oracle to go out and kind of complete these build-outs. And based on what we see right now, we expect we will need less, if not substantially less, money raised than that amount to go and fund this build-out. So hopefully that helps answer your question, Brad.
It does. Thank you. It's very helpful, and thanks for taking the question.
Your next question comes from the line of Ben Reitis with Melius Research. Please go ahead.
Hey, guys. Thanks a lot. Appreciate it. Good to speak with you. In light of the answer to that question, the path for OCI margins seems very important to improving the EBITDA and cash flow. So at the analyst meeting, you said margins for AI workloads for OCI would be in the 30 to 40% range over the life of a customer contract. I guess my question is, how long will it take your AI margins across all your OCI data centers to ramp to that level, and what needs to happen to get there?
Yeah, thanks for the question, Ben. Look, the answer is it really depends. So the good thing is that, as I mentioned earlier, we don't actually incur any expenses for the data centers until they're actually built and up and running. And then we've highly optimized the process by which we actually put capacity in and then are able to hand that over to customers, which means that the period of time where we're incurring the expenses without that kind of revenue and the gross margin profile that we talked about is really on the order of a couple of months. So in that scenario, that time period is not material. So a couple of months is not a long time. What actually matters much more is the overall mix of the data centers that we have online, right, and how they're growing compared to the total amount that we're scaling across the world. And so I think as we go through this build-out phase, right now we're in a phase of very rapid build-out without the majority of the capacity online. Obviously, the aggregate mix is going to be lower. But as we actually get the majority of this capacity online, and that's really our focus, the best way to improve margins quickly is to actually go out and deliver capacity faster. That ends up very rapidly ensuring that we get to that 30 to 40% gross margin profile for all of the AI data centers.
Thanks.
Your next question comes from the line of Tyler Radke with Citi. Please go ahead.
Yes, thank you for taking the question. And this question's for Larry or Clay. So Oracle has clearly established itself as a leading provider for AI infrastructure to AI labs and in some cases enterprise clients. How are you thinking about the opportunity to sell additional platform services such as database, middleware, other pieces of the portfolio, similar to how we saw cloud providers add that on at the early days of the public cloud space? And what might be some of the similarities or differences that you see with the emerging AI platform as a service market versus the traditional cloud platform as a service market? Thank you.
Well, let me start with traditional cloud and traditional Oracle database. I think the biggest change we've made there was to make our database available in everyone's cloud. So you can buy the Oracle database at Google or Amazon. It's available at Microsoft Azure as well as OCI. So that was that was the first move we made. We call it multi-cloud, and we actually embed OCI data centers within the other clouds. So they get the latest, greatest version of the Oracle database. Second thing we did is we actually converted the Oracle database or added capabilities to the Oracle database to allow you to vectorize all of your data. So it's a vector database. Some people call that an AI database. So it's designed to make data available to models. You can then, once you vectorize your data, you can place AI models on top of that, and the AI models can understand what's in the database and reason with the data that's in the database. So we think that combination of making the data available in our database also accessible by AI models dramatically increases the value of the data. We think that's so far, none of the other large-scale databases have been able to do that. We can do that, we can do that and keep your data secure. That's one of the bigger issues. We have to scale it, keep everything reliable, keep it secure, and we actually have to add all of those capabilities and features to the Oracle database. So that was step two. First, multi-cloud. Second, vectorize all the data and make it accessible by all of the popular AI models. Third step. Well, it's great that we're making the Oracle database data available to these AI models, but companies actually have data that's not stored in an Oracle database, is not stored in an Oracle application. So we built an AI lakehouse we call the AI data platform that actually points to and vectorizes all of your data, whether it's in an object store in different clouds, whether it's a bespoke application, whether it's in another database. It really will take the universe of your data, catalog that data, vectorize it, and allow an LLM to do multi-step reasoning on all of that data. Now, the thing that's really remarkable about that is think about asking one query, asking one question, and the model looks at all of your data. Normally, when you ask a question, you have to direct it to this database or this application. You can't say, look, I'd just like to know who's the next customer I should be selling to. I'm a salesperson in territory. I want to look at all the accounts in my territory, and I want to see who's the best prospect in my territory. Well, that means looking at contractual data. It means looking at publicly available data. That means looking at our sales system, at our support system, all of these separate systems. Well, suddenly all of that data is unified. We take all of your data and unify it, so you can ask a single question, and the AI models can find the answer to that question, regardless of what data store it's in. That's really a unique proposition, and we think that thing is going to turbocharge the use of our database and the use of our cloud dramatically.
Thank you.
Your next question comes from the line of Brent Thill with Jefferies & Company. Please go ahead.
Thanks. Question for Larry and Clay on the fungibility of your infrastructure. What would you have to do to convert a data center from one customer to another, such as if one of the larger customers was unable to pay?
Yeah, thanks, Brent. So I think the first thing to understand is that what we deliver for our AI infrastructure is exactly the same cloud that we deliver for all of our customers. We made specific choices at the beginning of OCI around bare metal virtualization and the way in which we do things like secure wipe of hardware, et cetera. But the reason I bring that up is that, take as an example, anyone right now with a credit card can show up and sign up for any one of those hundreds of regions that I talked about earlier, and you can spin up a bare metal computer in as quickly as a few minutes. And at the end of that, you can turn it off, and I will recycle that, and I can hand it to another customer, in less than an hour. And so when you ask the question of, well, how long does it take to transfer capacity from one customer to another, it's on the order of hours. And what actually I think is kind of a corollary to that question is well, then how long does it take customers to adopt it? And thankfully, we have a lot of experience getting more than 700 AI customers on our platform, including the vast majority of the large model providers already run on OCI. And when we give them capacity, they typically spin that capacity up in the order of 2 to 3 days. And so when I think about how long does it take for me to take capacity and hand it to another customer, it is not a laborious process. It is not a unique process. And something else I would say that I think a lot of people don't realize about our cloud is this is actually happening all the time. So, we have lots of customers that might sign up for a thousand of one type of GPU, and then they'll come back and say, well, actually, I'd like to get even more capacity somewhere else. Will you take this back? And we do that all day, every day, and we're constantly moving customers around and adding aggregate net capacity. So we have the technology, we have a secure base from which to do that, and we also have a customer base of a lot of demand, such that whenever we find ourselves with capacity that's not being used, it very quickly gets allocated and provisioned.
Your next question comes from the line of Mark Murdler with Sanford Bernstein. Please go ahead.
Thank you very much for taking my question, and congrats on the quarter. Doug, you gave some color earlier tonight that I'd like to dig in on. Clay presented a slide at the financial analyst meeting where he showed the revenue and expenses for a single data center. Doug and Clay, can you talk about the cash flow for that same data center, starting with the commitment for the data center and then the hardware, and how that flows into becoming cash flow positive, and then how that rolls up across multiple data centers? Any color would be really appreciated.
Sure. Happy to answer, Mark. So as we talked about earlier in this call, it starts with the actual data center itself and the power capacity along with it. And the way in which we structure that is that we incur no cash expenses until that's fully delivered and provisioned and fit for purpose. So then it really comes down to what does the cash flow look like for the capacity that's going inside the data center. And as I talked about earlier, that really depends on kind of the business model and the financial model that we've used for procuring that. In some cases, customers actually want to bring their own hardware, in which case we don't have any capital expense, and it's really around the data center itself, possibly some networking gear, as well as human labor costs. We have other models where vendors want to rent that capacity, in which case those rent payments start when the capacity is provisioned for the customer. And so customer cash flow comes in. We're then taking that cash flow and pushing that out to all of the different suppliers. And then obviously you've got the model where Oracle takes its own cash, pays up front for the hardware, and then puts the capacity in. That's obviously the most cash intensive up front. And then there's a depreciation schedule over the next several years. So it really depends on the exact business and financial model used for each of the data centers. And then you ask, well, how do they layer together? Well, thankfully, they're not. We don't need calculus for this one. Basic arithmetic is enough because they actually just layer on top of each other. So if you have a time schedule for one data center and a time schedule for a second data center, the cash flows add together. And obviously, if a data center comes in sooner, you'll have the expenses as well as the revenue coming in sooner. If a data center moves out, then the expenses and the revenue also move out.
That's very helpful. I appreciate it.
Your final question comes from Don DiFucci with Guggenheim Securities. Please go ahead.
Okay, I won't make you kiss my ring. It's actually John DiFucci. Anyway, I'm sorry. Listen, a lot of my questions on infrastructure have already been asked, and they're really important questions because that's a big part. That's your big part of your growth. But I have a question on the applications business. Mike, you said applications are going to accelerate this year. Why the confidence in this business when all your large SaaS peers are seeing just the opposite, where growth is decelerating? Especially because we thought that something similar about Oracle's application business last year, and we didn't really start to see it until the fourth quarter. We've heard some things in the field around One Oracle, your go-to-market motion, where apps and infrastructure are more combined versus separate. And you also talked about combining vertical and horizontal apps teams here. Is that it? Is it mostly go-to-market? Is there something more about the products or something else that we should be thinking about? Thank you.
Well, yep. Thanks for the question, Dad. First, I think it's a combination of things, but let me just start with what I think is happening in the industry. All of our competitors are largely in the best-of-breed business because they're not in the applications business in totality. They're not in the back office business. They're not in the industry business, and they're not in everything in between. They're not in the front of the house, the back of the house, and the middle of the house. We are the only applications company in the world that's selling complete application suites. Then you add in baked-in AI. The AI halo, baked-in AI right into our application. So we're over 400 AI features live in Fusion already. I mentioned 274 customers live on our clinical AI agent. The go-lives for these clinical AI agents, which are a new breed of SaaS applications for us, are measured in a matter of weeks. And you're looking at an industry like healthcare where it would take months or years to get anything done of that magnitude. Weeks. And by the way, John, the customers are implementing these things all by themselves. They don't need us to help them. You just roll them out and they work. So we're in the applications industry suite business. We're building AI into our back office applications, our front office applications, and we are building applications that are also AI agents themselves. They are in fact AI agents. That's why you see the growth rates in our industry applications of 21%. In the quarter. Our Fusion ERP is up 17%, SCM up 18%, HCM up 14%, CX up 12%. Again, all on a bigger base. Then I think the next piece of this is you add in the AI data platform. So if you'd like an industry suite of applications, then you'd like to create your own AI agents. You'd like to create and unlock your own enterprise data on top of it all. We are the only all of those ingredients for a customer. And I think as you look at customers, tiring of spend on best of breed because the integration costs are so high, and it's hard to bolt AI onto all of that because you're actually not retiring anything in the process. We're in a very unique position, and I think we're starting to see it in the numbers too, John, with the deferred revenue for apps growing at 14% now. Faster than the in-quarter revenue growth of 11%. For all those reasons, I'm optimistic on our apps business going forward that it's a continued growth engine for Oracle.
Thank you, Mike. As you were talking, it sort of clarified in my mind. When I think of One Oracle, I thought of it when I started to hear about it as a go-to-market motion, but it's more than that. It's actually it's a product thing too. It's everything. So thanks a lot.
Thank you.
Thank you, John. A telephonic replay of this conference call will be available for 24 hours on our investor relations website. Thank you for joining us today. And with that, I'll now turn the call back to Tiffany for closing.
Ladies and gentlemen, this concludes today's call. Thank you all for joining. You may now disconnect.
Thank you everyone for tuning into the Oracle call and FedNest Day. It was a lot of fun. The Fed delivered and Oracle took away, right? We got below that put wall in trading here. I would be concerned about what this looks like going into tomorrow. It doesn't sound like people like what they heard on the call. This is a company that produced mixed earnings. They beat on the bottom line, but they missed on the top line. So, there's a lot to not be too happy with what we saw from Oracle. And that does take some of the wind out of the sails of the generative AI growth story. So thanks for tuning in. I'll be back real soon with more. Hope you all have a great night.